In today's video, we are going to talk about dividends and how they work with whole life insurance policies. So if you have a whole life insurance policy, or perhaps you're considering one right now and trying to understand dividends, it can be confusing. For example, let's say you have a policy, you've got $100,000 in cash value, you're with a company that has a dividend rate of 6% this year, so the growth should be what? $100,000 with a 6% dividend rate equals $6,000. However, when you receive your annual statement, the annual dividends you received from the life insurance company read $1,500. And you're like, what? This doesn't make sense. But then if we were to track the actual cash value growth, you'll see that the growth is $4,000. So more than the dividend, but still not $6,000. So it can definitely be a head scratcher. So we're going to talk about why that is today. We're going to talk about how dividend rates work, breaking down both the dividend rate and the guaranteed rate. And then we'll break down some illustrations and look at the actual dividend column with an individual pumping money into a life insurance policy. We'll see what the dividends look like with respect to annual growth, but then also the net cash value growth, which is much, much more important in my opinion. So let's get on into it and have some fun, shall we? What we will begin with is dividend interest rates. So what we've got in this example is a dividend rate of 5.75% for 2023. That's actually Guardian's dividend interest rate. Guardian is one of the major mutual companies, and when we look at the examples, they are based on Guardian illustrations. The guaranteed rate with many of their products, including the ones we will look at, is 3%. So if you were to Google search Guardian's dividend interest rate, what would pop up online is 5.75%. However, what that dividend rate is made up of is the guaranteed rate with a floor of 3% and then a declared surplus, in this case, of 2.75%. And now that's important to note because when we actually receive dividends from a life insurance company, or if we were to look at a life insurance illustration, the actual dividend that we see from the life insurance company on their literature often does not reflect the guaranteed rate. For example, if we look at a life insurance illustration and we see the dividend column, that does not reflect the total dividend rate that we would see online of 5.75%. It only reflects the surplus piece of 2.75%. If we look at our annual statement, which you will receive every year from the insurance company, when you see dividends received of X amount of dollars, say it's $1,500, that again only reflects the surplus piece. The same is true of your online portal, as that will tell you what you will receive or have received in dividends. So anytime we see a dividend received from an insurance company, it is often just the surplus piece. Now, if you were to ask, why do insurance companies do that? Because if they say, here's our dividend rate, the dividend column should be reflective of the total dividend rate, I would agree, but that's not how it works, unfortunately. This is how the industry works. It has worked for a long time. So really just understanding how they operate and making sure things are doing what they're supposed to is the most important thing to do on our end, really on the agent's end, but a lot of people we work with like to understand this as well. But most important piece here, dividend columns, annual statements, anything you receive from the insurance company that says, here's the dividend you've received or what you will receive, always keep in mind that the guaranteed portion is often not reflected in that. So the bottom line here, here's what I would want to know. How much money did I receive? So we've got all of these different terms and such, which can be very confusing, but what did I actually get? And if I am a rate guy or girl, meaning I want to see what's the actual interest rate, well then what I want to look at here is what's the dividend rate, but then what's the IRR, which stands for internal rate of return. You'll see that terminology used with life insurance companies. If someone's trying to understand the net growth rate on a policy, that's what we want to look at with a life insurance product. If you like dollars, meaning what's the total dollar amount that my policy actually grew by this year, we can look at dividends received, but then compare that with the total cash value growth. Very important to do that. So we're going to look at two different products. We're going to look at one that provides high upfront cash value. This will be an L95 policy with a 5% PUA fee, which will have very strong guaranteed cash values and an early break-even point, great for strong upfront cash value. Then an L99 product, which has a 10% PUA fee, and that product with Guardian is designed for stronger long-term performance. But what we're going to look at in these examples is really the dividends compared with the actual cash value growth. And one other thing I want to mention, I neglected to mention this and it's important, is anytime we see any of these rates from the insurance company take the total dividend interest rate, it is always a gross rate that is applied to your policy after the company's insurance expenses and everything that comes with your life insurance policy, which is why I am a huge fan of the internal rate of return, because I can just see the net rate. That's what I'm interested in at the end of the day. So let's take a look at an illustration first. And what we've got here is that high upfront cash value product. So it's designed for maximum cash value, minimum premium, maximum PUA rider, all that fun stuff. Here's our net payment each year in this illustration, $100K per year for 5 years, funding it for a short period of time. Here's my dividend column. Let's circle this in blue. End of year dividend. What that represents is when the dividend will be applied to this individual's policy. So we see in the first year, no dividends are paid. That typically is the case with life insurance products. But then year 2, we see a dividend paid, in this example, $41.72. But if this is your policy, good to be aware of the fact that this will be applied at the end of the second policy year, which is why at the end of each policy year, you will see your cash value jump. If you're tracking your online portal, the day before, day 365 of my policy date, I might have 185, and then the next day, when dividends and such are applied, I've got 190 and change. But as we look at this column, we see the dividends building over time. You see a slight drop here because we exercised what's called a reduced paid up. We eliminated the premium, which resulted in a slight drop, but then it recovers over time. Let's look at year 10. Year 10, the dividend's what? $10,263. Look at your cash value growth. Year 9, what was it? $608,000. How much did you pay into the policy in year 10? 0, not a penny. The cash value grew to $634 and change. Dividends were $10,000 and change. 608 to 634. Is that more than $10,000? Yes. If it was 10,000, it would be worth 618. So often, this sparks questions where one asks, okay, what's going on here? Like, why is the growth in the policy, when I look at the net cash value, greater than what the dividend column actually shows? Remember, here's the answer. Remember this. Surplus only is the dividend. The guarantee portion is included in this. The guarantee portion is not included in this. That's why. Let's continue on. Let's take a look at the other illustration, which is our L99 product. Net payment, exactly the same. Here's our dividends. You won't see a drop in this example. Continues to increase with this particular design. There will be times that you will see that drop depending on how much we fund and such. But same thing, if we look at year 10, the dividend here, $13,643, but it grew from $588 to $617, which is more than $13,000. So here we can get a sense of what the dollar amount looks like. We're going to look at the exact in a second. We're going to look at both the rate and the dollar. But a question some have is, okay, if the dividend rate is 5.75% and I apply that to this, it's not growing by 5.75%. What's the net growth rate? The internal rate of return. The same is true of dollars. So let's take a look here in dollars and also the rate. So on the left, we've got growth in dollars. And here is our L95 product, which has stronger upfront cash value, particularly with the 5% PUA fee. If we go to 10% PUA fee, it's very similar to the L99 long-term with a bit more upfront. but not as much as this guy up front. If that makes sense. We've got a video that breaks down the 5% and 10% PUA fee. So 100K goes in, first year in cash value, 88,000 and change. The dividend on the illustration and what we receive from the company is 0. Cash value growth for the first year is what? Negative $11,627 because I paid in $100,000 and I have 88 and change. That's a loss, no matter how I slice that. Year 2, I pay in $100,000 again. My cash value was 88 and change. The end of year 2, it's 190 and change. So on my annual dividend statement and on the illustration, I've got 4172. However, the actual cash value growth is 2403. And you will see this in the early years where the dividends received, the surplus piece, actually exceeds the total cash value growth. That has to do with the expenses on the policy still exceeding the total gains and such. We've got other content that breaks that down. But my point is, I don't really like this number here because it can cause confusion. Because if I simply look at how much I had in last year, factor in my payment, what's my cash value at the end of the second year, here's the net dollar amount. And then I can look at it year over year, year 3, they're very close to each other. And then from that point forward, and this will always be the case over time, the actual cash value growth will be greater than the annual dividend column I see on a life insurance illustration and what I receive in my annual statement for that matter. Now, as time passes, we always want to run in-force illustrations and keep our finger on the pulse of the company, the product, everything, because the dividend rate will change. They adjust over time. So we want to make sure we're always providing a fresh illustration with actual values moving forward. But based on this illustration, what do we see? As time passes, the actual cash value growth is greater than the annual dividend. So it's good to have awareness on what that dividend is. But if you were to ask an insurance company, what did I receive in dividends this year? You're going to get this number most likely. The number that you see in your annual statement and online account. And if I'm you and I ask an insurance company that, what did I receive in dividends this year? I'm going to take their word that that's what I received in total growth. But then, if I were to actually crunch the growth on a whole life insurance policy, I'd see that I receive more. Very confusing. The good news is you don't have to do this. Your agent can easily do this for you. This is something I like to do with everyone we work with, especially if they're trying to figure it out. We just put it right onto Excel, provide a copy of the formal illustration, and then we can see it side by side, and it creates that, I understand now. Thank you. Let's move on to the next topic. At least for me, it does. All right. So here's our total cash value growth in dollars on a yearly basis. And then the same thing from a rate perspective, because here I've got a dividend rate of 5.75%, but does it ever hit that 5.75%? No, because this is a gross rate that is applied after the company's insurance expenses and such. So here, we've got our annual internal rate of return on cash value. There we go. And we can scroll down and such, but this is something every year when we create live illustrations, for example, and track the actual performance. What I like to do is see what's the total dollar amount that you paid in each year, what was the actual cash value from your annual statement and what the insurance company documented on the online portal, everything, like your actual value at the end of the year, and then see what was the net IRR each year. That's how we track the actual performance of a policy. It's a lot of fun because it creates transparency as far as what actually happened, not just a projection. So point to that is this will change over time. So let's take a look at the policy design for strong long-term performance from an illustrated standpoint, that is. Same thing, growth in dollars, and then growth rate. A lot of people elect against this policy, and you can see why in the early years. Kind of screams at you. Where I'm taking a hit on my money 3 consecutive years. By the third year, it's almost a wash. But if I look at this, I pay in $100K. We got $83,000 in change in cash value. And this is a policy with a minimized base premium. The base plus the term is less than $10,000 per year. Everything else is going into PUAs. And there's the cash value growth. In fact, let's make that column a little bit bigger there so I can see the word growth. Perfect. And here's where it gets really confusing, because think of it this way. Let's skip year one. At the end of year one, you have $83,000 in change. Year two, you're paying $100,000. We'll pretend you pay it all up front in this example. And by the end of the second year, it's worth $173 and change, which means you took about a $10,000 loss. And we can see that here actually, over here. Cash value growth, just about negative $10,000. Yet the insurance company sends you a statement that reads annual dividend $44.27. Can be extremely confusing, because if I receive this, I would think, hey, my money grew by this much this year. That's fantastic. The dividend helped offset the loss there, but if I simply look at how much I paid in and then what the cash value actually grew by that year, net, I took a hit. Same thing in year three. The dividend is even higher, 67.62, but when I look at my cash value, just about a wash. I lost $300. But then as time passes, what do you notice here? This will always be the case. The actual cash value growth, which includes the dividend, and it also includes the guaranteed piece. What happens here? It exceeds the annual dividend column. Again, we'll see that occur every single time. So there it is in dollars. And then if we look at the same thing here, based on a rate, do you remember what the last example peaked at in terms of the internal rate of return? It wasn't almost 4.9%. So the purpose behind a higher PUA fee is an insurance company is treating it similar to how they treat base premium dollars, where basically they're saying, if you give us more upfront, we'll be able to do more with that money, and we should be able to give you more money long-term on a non-guaranteed basis. So you do receive a little bit more long-term potential there. However, from a transparency standpoint, it's always important to see the guarantees in those cases as well, because with the guarantees, it's the opposite. When I look at a low PUA fee, it'll have less long-term on a non-guaranteed basis, but more long-term on a guaranteed basis. I would check out this video for more information on that. But same thing here, when we look at the total dividend rate, while the annualized IRR is stronger, does it hit 5.75%? No. This is my net growth rate at the end of each year, based on this illustration and present dividend interest rate. However, that is still attractive. This is really why a lot of people are attracted to cash value life insurance products. When I look at the core benefits of the cash value, it's what? A safe, liquid, tax-free area to position money. Can access it, use it as a personal line of credit for opportunities. I've got a healthy death benefit as well that can be used for income protection and or estate planning. So there's a lot of advantages there. But what I don't want, like what can mess everything up here, is if you purchase a policy under the expectation that your money is going to grow by the illustrated dividend rate, and then determine or then find out on your own that the IRR is significantly less than that. That it's right around 4%, maybe a little bit more. As opposed to knowing that up front and being comfortable with it, then it's, hey, this is perfectly fine. Which is, by the way, how corporations and wealthy individuals with third-party advisors, it's exactly how they do it. They've got everything provided to them up front. They've got awareness that the net growth rate, the IRR, will produce somewhere between 3 to 5% over the life of the policy, and all of the things we talk about all the time. But from a dividend standpoint, I do like talking about this because I can see, all right, the dividends, here's what the insurance company is providing, which is beneficial. But at the end of the day, like, I want to know what the net growth rate is or the net dollar amount is that I received from the insurance company, because it's my money and I want to know how much it grew by. So I hope you enjoyed this video. If you did, please hit the like button, subscribe, share it. If you have any questions or comments, please leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.